All right, welcome back to The Explainer. Today, we have an absolutely massive briefing to get through. We are doing a fast-paced breakdown of some of the absolute highest stakes financial news to hit the tape this entire season, from potential Wall Street mega shakeups to unprecedented multi-billion-dollar plays for global soccer, plus an absolute deluge of corporate earnings data. So grab a coffee, lock in, and let's break it all down right now. Okay, let's just dive right into this. The underlying theme for our entire session today is pretty simple. Billions of dollars in play and an absolute earnings deluge. We aren't just talking about minor market blips here. We're looking at massive structural shifts in corporate ownership, high-flying billionaires making really aggressive plays, and a flood of economic data that is forcing investors to completely recalibrate their strategies. And on top of all that, the mega-cap tech giants are literally just hours away from reporting their numbers. There is a huge amount of data and high-stakes corporate drama to cover, so let's get right to our first major theme of the day.
Section 1. Global Deals and Drama.
So check out this stark contrast in the messaging coming out of one of the world's most powerful financial media empires. On one hand, we're hearing about IPO talks. Reports have actually surfaced that Bloomberg executives held preliminary discussions with bankers regarding a potential initial public offering or, other strategic transactions. That alone sent shockwaves through the financial sector. But then, right on the heels of that, a spokesperson quickly stepped in with a hard no full sale, clarifying that founder Michael Bloomberg has absolutely zero plans to sell the company outright. So the crucial takeaway here is that while an IPO might not be entirely off the table, a full-blown sale of the Bloomberg empire appears to be a total non-starter for now. It's just a fascinating peek behind the curtain of private financial media.
Meanwhile, shifting gears to the sports world, FIFA is making some incredibly aggressive moves. They've unveiled plans to create a staggering $20 billion commercial entity specifically to manage the World Cup. To fund this whole shebang, they're aiming to sell minority stakes to private investors. And notably, the Kushner family has actually been named among those potential backers. Now, as you might guess, commercializing the world's most beloved sport at this kind of scale, it has triggered a fierce backlash from soccer organizations all over the globe who are deeply, deeply concerned about the financialization of the beautiful game.
And I think this brilliantly illustrates the clash happening right now in global sports finance. Just listen to this quote from FIFA president Gianni Infantino. Instead of backing down, he is firing right back at his critics, publicly telling them to, quote, meditate, pray, or watch football rather than attacking the governing body. Wow, this isn't just PR spin. This is a defiant line in the sand. It shows exactly how confident FIFA is in their massive $20 billion monetization strategy, despite all the intense international resistance. This is absolutely going to be a major ongoing flashpoint in the business of sports. Moving on to Section 2, Macroeconomic Reality Check. 90.8. The Consumer Confidence Index for June just marked a decline for the third straight month. With the consumer basically driving the entire macro engine, this prolonged downward trend is a very clear signal that persistent inflationary pressures and, honestly, growing jitters about the job market are seriously weighing on sentiment. People are getting nervous about their wallets for sure. On a slightly different note, let's look at the trade side of the equation. $101.5 billion. The U.S. goods trade deficit actually narrowed by 4.2% to hit this $101.5 billion mark in June, primarily because imports fell. Now, on the surface, a narrowing deficit sounds like a victory, right? Like less money flowing out. But we really have to look a layer deeper here. Because economists, they do not see this narrow deficit as a reason to celebrate. Actually, it's quite the opposite. Since this drop is driven by falling imports, which means domestic businesses and consumers are actively pulling back on buying goods from overseas, economists expect trade to actually subtract about a full 1% from Q2 GDP growth. So the key takeaway is that this metric isn't a sign of strength, it's just another significant headwind for the broader macroeconomic picture.
All right, Section 3, the earnings scorecard.
Let's rapidly run through these Q2 earnings standouts to find the stories you really need to know. First up, Amphenol. Just an absolute monster beat. Revenue surged 55% year over year, crushing estimates by over $500 million, with earnings per share jumping nearly 67%. This connectivity giant is just firing on all cylinders. Next, in the semiconductor space, KLA Corporation showed continued strength in chip equipment demand, with a solid 15% revenue bump. Over in energy, Cenovus Energy absolutely soared. Revenue spiked 42%, but get this, their EPS rocketed up 236%. Crazy, right? Now, Vertiv Holdings is a really fascinating mixed bag. This AI infrastructure play actually missed revenue estimates by a hefty $100 million, yet they beat on EPS by 60 cents. What that tells us is they have incredibly strong margins, but potentially softer volume than the market was expecting. Finally, wrapping up in fintech, SoFi Technologies continues its aggressive growth trajectory, easily beating estimates, with revenue up 40% and EPS up 50%.
Section 4. Banking and Healthcare Updates.
When we look at major global banks like UBS and Deutsche Bank, it's really a tale of top-line glory versus bottom-line reality. For both banks, revenue completely smashed expectations. The money is pouring in. But on the flip side, both of them missed on their earnings per share. Why? Well, rising costs. Everything from labor to integration expenses are aggressively eating into their profitability. It's a great reminder that making more money doesn't always equal keeping more money in today's inflationary environment.
Now, contrast that banking squeeze with what we're seeing in healthcare. Humana delivered a very strong beat. Revenue is up 26%, and they beat their earnings per share estimates by a massive 80 cents. This perfectly showcases the incredible resilience of the managed care sector. Even when consumer confidence drops and banks struggle with rising costs, healthcare often remains a highly defensive, really resilient pocket of the market.
Which brings us to Section 5, the Mega Cap Showdown.
Let's walk through this suspenseful timeline together because this is where the market will literally be won or lost this week. Right after the closing bell today, Microsoft is set to report. Analysts are expecting nearly $88 billion in revenue, and you better believe every single eye will be glued to their Azure cloud growth and those massive capital expenditures in AI. At the exact same time, Meta takes the stage. The street wants to see $60.2 billion in revenue, but the real focus will be on their ad pricing power and Reels monetization. And if that wasn't enough tomorrow, hold on to your hats. Apple is expected to post nearly $109 billion in revenue, with everyone hyper-focused on whether iPhone demand in China is holding up. And finally, Amazon is staring down a massive, nearly $200 billion quarter, $196 billion in expected revenue to be exact. The sheer scale of these numbers is almost hard to wrap your head around. So, this brings us to the most important question of the day. With all this data crashing together, the global sports deals, the shaky macroeconomic consumer data, the mixed banking results, and now the colossal weight of these mega-cap tech earnings, will this 48-hour stretch define the market trend for the rest of the entire summer? The stakes truly could not be higher, and the data is about to hit the tape. Well, I hope this explainer gave you the structured clarity you need to navigate the chaos ahead. Keep learning, keep watching the data, and we will see you next time.